Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets hidden in corporate filings. And today we are looking at Zoomcar Holdings Incorporated and their latest financial report. Get ready because this one is a wild ride through a company fighting to stay afloat while navigating a sea of debt and legal challenges. It's a real roller coaster. Before we dive in, be sure to hit that subscribe button and join our Discord community, linked in the description below. We break down these complex documents so you don't have to. Zoomcar is essentially a car sharing company that connects car owners with people who need to rent cars. They operate primarily in India, and right out of the gate in their filing, they are very upfront about their struggles. The company admits they have a critical lack of cash and are not making payments to their creditors on time, and this raises serious doubts about their ability to continue operating. They need money fast, like yesterday fast, to keep the lights on for the next year. In fact, as of the 31st of December 2025, Zoomcar had only $208,175 in cash. And get this, they mentioned their cash position was critically deficient. This is not a good sign, folks. They are basically saying they can't even pay their bills. To survive, Zoomcar has been scrambling for cash through various financing deals. They have issued a lot of unsecured notes, convertible notes, and redeemable promissory notes during 2025. It seems like every month there is a new deal to bring in cash, often at very unfavorable terms for existing shareholders. They even did a couple of reverse stock splits, one for 100 and then another one for 20. This is usually done to artificially boost the stock price and meet exchange requirements, but it also means your shares are worth a lot less and you own a smaller piece of the company. Looking at their revenues for the 3 months ending the 31st of December 2025, their total net revenue was about $2.37 million. This is actually a slight drop from the roughly $2.45 million in the same period last year. For the 9 months ending the 31st of December 2025, their revenue was about $6.96 million, which is also a small decrease compared to the previous year. The business isn't growing its revenue, it's actually shrinking slightly. Now let's talk about costs. Their cost of revenue dropped significantly by 28% for the 3 months and 15% for the 9 months. This is largely due to company-wide efforts to be more efficient, cutting down on repairs software and even personnel. So they are cutting costs, but their revenue isn't keeping pace. Their general and administrative expenses also saw a big decrease, particularly professional fees and rental expenses. They've clearly been focused on cutting overhead wherever possible. But here is where it gets really painful. Their finance costs are enormous. In the 3 months ending the 31st of December 2025, these costs alone were $474,036. For the 9 months ending the 31st of December 2025, it was $1.38 million. A huge chunk of this is from interest on various loans and the change in fair value of certain notes, but also a staggering amount from costs related to issuing stocks and warrants. This shows how much they are struggling to manage their debt. And then there is the other expense income net line item. For the 3 months ending the 31st of December 2025, they reported a substantial other income of $1.23 million. This is a big swing from the previous year when they had other expenses of $757,000. The filing mentions gains from writing off liabilities and recovery of taxes. However, they also incurred losses from litigation settlements. The company uses a metric called adjusted EBITDA to show how their core business is performing without certain expenses. Their adjusted EBITDA loss improved significantly to about $830,000 for the 3 months ending the 31st of December 2025, down from over $3 million last year. This improvement is primarily due to all those cost-cutting measures we just talked about. Now let's talk about the legal battles, because Zoomcar seems to be in a lot of them. There is a lawsuit from a former employee claiming wrongful termination and seeking damages. There is also a very serious legal fight with someone named ACM, who has filed for summary judgment demanding millions for unpaid amounts under a note. The company is appealing this. They are also facing a lawsuit from their founder and former CEO Greg Moran, who is contesting his termination and claiming significant equity and compensation. The court has dismissed some of his claims, but the case is still ongoing. And as if that wasn't enough, they received a demand letter from a previous placement agent claiming fees and warrants for past financing rounds. They have set aside over $200,000 for this. It's clear the company is managing a very complex and risky business. On the internal controls front, the company admits to several material weaknesses. These include issues with reviewing third-party advisor reports, inadequate financial reporting policies, and deficiencies in accounting expertise and its controls. They are trying to fix these, but it is an ongoing process. The risk section is frankly eye-opening. They explicitly state they have a history of losses, negative cash flow, and limited cash resources, leading to substantial doubt about their ability to continue as a going concern. They are constantly raising capital through dilutive financing, which is essentially mortgaging their future for immediate survival. They also warn that future sales of their stock could cause the price to drop significantly, and that the exercise of outstanding warrants could further dilute ownership. They are in talks to perhaps exchange warrants for shares, which could lead to a huge number of new shares hitting the market. And remember, their stock is not even on a major exchange, it's on the OTCQB, which is basically a less regulated market. This makes their stock price very volatile and hard to sell for a good price. They basically admit that US broker-dealers are discouraged from trading their stock because it might be considered a penny stock. If they can't meet the OTCQB requirements, their stock could be delisted entirely, which would be devastating for liquidity. Zoomcar is in a precarious financial position. They are burning through cash, are heavily indebted, and facing multiple legal threats. While they have managed to cut costs and improve some operational efficiencies, the revenue is stagnant and the debt burden is crushing. They are constantly chasing new funding, which dilutes existing shareholders without fundamentally fixing the business's core issues. The company is essentially surviving on a lifeline of loans and new equity that comes with serious strings attached. The multiple lawsuits and the admission of a going concern doubt paint a very grim picture. It really feels like they are in a fight for survival, and the odds seem heavily stacked against them. In conclusion, Zoomcar is a company making desperate moves to stay alive. The financial health is extremely poor with critical cash shortages and massive debt. The legal battles and lack of confidence in their internal controls amplify these concerns. The path forward is incredibly uncertain and investors should be extremely cautious. Alright, that is our deep dive into Zoomcar's latest filing. What do you think about their chances of survival? Let us know in the comments below. If you found this analysis helpful, please give it a thumbs up and subscribe for more corporate breakdowns. And don't forget to join our Discord community linked in the description for even more insights. Thanks for watching, see you next time.